Well, good morning, everyone. Once again, I want to welcome back Keith Murphy from Essex Mortgage. Good morning, Keith.
Good morning, Kelly. Happy Saturday to you. Thanks for having me on again. I really appreciate this.
Thank you. I appreciate your time and I know how valuable it is. So let's hop right into it. We were going to talk this week about what happens when you're in contract and one of the first contingencies for the buyer is to have that appraisal done. And that's the valuation, the independent third-party valuation of the property as a market value. And what happens when that comes in below the contract price. So I know we've had a couple of times where it's happened, for our buyers, for our sellers, and it can run into a little bit of a sticky wicket. So how can we overcome that? What are the various steps? So with that, I'll just ask you to go ahead and take it away with step one.
Yeah, sure. Well, I see really three common sense steps that we together have deployed, and the strategy goes like this. First and foremost, when an appraiser goes out and appraises a home and it comes in below the contract or agreed upon price between buyer and seller, we're asking for that appraiser's opinion of value. That doesn't mean that his or her opinion is accurate. So the first thing that you and I do, Kelly, for our clients is tear into that appraisal and look through everything with a fine-tooth comb, from what comparable sales were used. Were they the highest and best? Were there any other more recent sales that would have supported the value that the appraiser overlooked or didn't use? What were some of the adjustments they made? Like, some houses have pools, some don't, garages, some have big lots, some have small lots, some have remodeled kitchens, others have the original kitchen. There's so many things that go into determining what is the real market value of the property. And just because an appraiser doesn't see the value of a brand new kitchen like you and I might, that adjustment for that kitchen might be low. A bullet point list of all the things that the appraiser may have overlooked that we're in disagreement on, and we can submit what's called a rebuttal report. So for those watching, Kelly and I will put together a detailed report, bullet pointing every single thing that we are in disagreement with. And if there's additional sales or comparables that should have been used, that's going to get added to the report so that we can professionally show and enlighten the appraiser's opinion. Like, maybe you didn't notice this and this and that, and if you had, the value would have been there. And if we can win that rebuttal, the value gets readjusted back to what we hoped it would have been, which is the contract price, and then we're moving on down the line. Case solved. But a lot of times these appraisers who aren't a part of the transaction and are very strong in opinion stand by their ground on their opinion of value, regardless if it's even something very obvious. Like, gosh, you used a sale on the most recent one we're going to show everybody. You used a sale that was on an interior lot. Client has this larger size corner view lot of a canyon, no other homes in sight. It's this beautiful view, and the adjustment you give that is a $5,000 delta. That doesn't make any sense when typically something like that might be a $30,000 adjustment.
I just wanted to hop in here and say that it's been my experience that one of the reasons that I've seen appraisers not be willing to look at, well, we feel like you should have adjusted more for that view, is that there are trends in, just as we see, trends in the economy, when we were going through the downturn in the economy back in 2008, 9, and 10, and properties were using value because, value is all about the perception in the mind of the buyer, but it's also about value in the value perception in the mind of the appraiser. And I've heard it described this way: appraising is an art, it's not an exact science. And those folks are independently licensed and certified, and they may be seeing trends that are being applied to a market segment And they may not be aware that, well, while that trend may be going on, say, for example, in Riverside County, how things are trending in Beaumont is not going to be the same as how things are trending in Corona. So that's where, without offending them, we have to diplomatically present that rebuttal that says, look, here are the facts, and we would, strongly request that you reevaluate and see that maybe this actually deserves a little bit more value here.
Absolutely. And on that note, I think it's very wise of you to point that out to everyone, that this is an art form. And I would liken them to a business analyst or stock market analyst who's going to say, hey, look, let's talk about if it's a company. Year over year, your revenues have gone down. Year over year, your margins have gone down. You're losing customer market share. Therefore, I need to extrapolate out into the future what I think your company is going to be worth based upon these trends and data I'm seeing now. So when they're looking at the market, and this is real, where you see a significant reduction in the number of listings, as an analyst, you may say, oh my gosh, the market is slowing down. There's less sellers out there. Well, what they're not taking into account, in my opinion, my humble opinion, I'm not an appraiser, but if you look at the number of buyers that we get to see that isn't a part of that equation, there's more buyers wanting to go out and make an offer on home, especially under this shelter in place. It's changing people's perceptions from, oh, I'll just rent for right now, to no, I want my own home. If I'm going to be at home, I want to be in my home, and I want this yard, and I want these amenities. And then they're going out to the market and they're not finding what they're looking for because of limited inventory. Why is the inventory down? Because a lot of sellers have put their selling and then trade up or trade down plans on hold because they don't want a bunch of strangers walking through their house. When their kids get home from school, they've still got to have homework sessions and lunch, and there might be germs there. So I get why sellers might be wanting to put things on hold, but that does not mean that the market's trending downward.
Correct.
And that whole appraised value may be influenced by that very fact. They're looking at the data, but maybe in not the same way you or I would.
Right.
So
we have to remember,
back to
these
our
are
game plan.
Yeah, they're people. They're just like you or me, and we have to respectfully disagree and present the information and just appeal to their sense of, okay, you know what, there might have been a chance I overlooked something without, offending the ego, and so it's not to say that, they're walking around, oh, I know everything, and nothing, but everyone has their own perception of value. And as much as we think, okay, you're going to bring a complete scientific approach, not necessarily so. It is an art form.
In my view, Kelly, has always been the market price of a home is determined based upon two things: what a seller thinks it's worth and what a buyer's willing to pay for it. And when they meet in the middle and set a price on a contract, that is, to me, that is the new market value. And that's how things appreciate. If we only looked at, well, the houses in this neighborhood have never sold for this price, well, then a market would never move up. It would be flat forever. So by that virtue, I think there's always room there left for interpretation and opinion, and that's where our opinions, along with opinions, come into play, and we do what we do if we see error. Sometimes the prices are just too far out of where the market adjustments are, and we have to move on to plan B. So plan B is, okay, we attempted the appraisal rebuttal and it didn't work out, or there wasn't anything to rebut. The appraiser's opinion was very valid. We are overpaying for this house. We don't want our buyers to overpay, so we're going to renegotiate. And that's where your skills come in, and you go back, and I'll let you talk about this, but you go back to the seller and say, listen, we initially agreed to this price, but now that we've got this data from the appraiser, it's clearly not worth what this buyer was willing to pay. And in order to get their financing taken care of, we're going to have to lower the price. In my opinion, being on the lending side, I think the best outcome is a win-win outcome where, let's just make up some numbers. The contract price was $450, the appraisal came in at $440, so we have a $10,000 difference. Maybe the buyer comes up to $445 and the seller comes down to $445. They meet somewhere in the middle, and we move on and restructure the upon that new number. That negotiation piece on step 2.
Yeah, so there's a lot that comes into play when it comes time to go back and do those renegotiations. And typically what I like to do is from the very beginning, when I'm first counseling and doing that buyer consultation, I try to suss out what their experience has been when they've purchased in the past, if they ever have purchased, and walk them through these various steps and let them know that there is a chance that you're going to be up against multiple offers. And especially right now, we're definitely seeing that. When we are in a multiple offer situation and prices are going up, there is a likelihood that that appraisal will come in below the price that you're willing to pay for it. So from there, you have to look at, from the standpoint of the seller, they had multiple offers and they've got multiple buyers that if you are not willing to pay the extra 5 or 10,000, somebody else will. And that's where we also look at, so they have to strongly consider that. I want them to consider that. Are you willing to spend an additional, 2 or 3% to be able to get the perfect home for you and your family? And it may be that when, maybe you don't have the money to do that. But if you do, and it's the perfect property, are you going to be willing to do that? So I really want them to come to the table with that mindset that that's the potential. Not saying that I can't negotiate, but the seller does not have to. And that's the other step that I like to, or the other fact I like to let them know. The seller has no obligation to lower the price. And it says that right in the contract. So that's why I like to read through a contract with them right from the very beginning and counsel them and let them know that. And then to say also, if this is the perfect home for you and your family and your intentions and your plans for the next 5, 7, 10 years, are you even going to remember that extra $5,000 that you paid for that property in 10 years? When you've had so much enjoyment from the property, it's been the ideal commute for you for work, the school is great. And when you look at year over year, the appreciation in the property that you've gained. So those are definitely things to think about. It's not just where are the dollars?
Right.
Do I have the money to do it? That's important, but it's not the only thing to consider. So we always have, the initial contract price, and then if we end up having to, we've got, the renegotiation possibly of price and renegotiation when we do our home inspection. So those are 2 other places to look at. Another thing that tool I've used in the past is I've said, okay, well, we were initially coming in with the buyer paying, $450. It appraised at $440. How about if they pay $450, but you give them $5,000 credit toward their closing costs? So it's kind of like the dollar's in and the dollar, moving the dollars around, but there are a lot of different tools.
I love that. And that insight is why you and Glen are top of the food chain when it comes to buyers and sellers in your marketplace. Because there is, you're right, so much more information and data points and facts to consider long-term than just that price spread between what did we agree to originally and what's the appraiser saying. So very, very insightful there. Maybe it's a good time to move to plan C.
Yes.
When the plan A didn't work out, the plan B, like you said, they've got 20 other buyers who want to write an offer, who are willing to cover the difference. And mathematically, theoretically, it makes sense for the buyer to consider paying more. What do you do then? when you're a buyer and your funds are limited, but you still want to make the deal work. So that would be plan C. And I would call that strategic or creative financing, ways to restructure the loan to give the buyer the same or essentially the same result and keep the house when the seller is not willing to budge. So I'm gonna do something I'm not really fluent at yet, Kelly, and that's share my screen. So bear with me here. So this little spreadsheet, I'm gonna walk you through it. And for all your clients watching, hopefully they can follow along. But right here, this is a recent real-time transaction of Kelly Nelson's, and the steps that we just talked about were what we went through exactly. We rebutted the appraisal. The appraiser didn't budge. We approached the seller. Kelly approached the seller. The seller wasn't going to budge, but the property was exactly what the clients wanted. And even though the numbers weren't lining up, they wanted to know what they could do. So here is what they did. This was the original ideal if it had appraised for its purchase price. So they wrote the contract at $375,000. They were going to put 20% down, which was $75,000 from the sale of their home, their departing residence, and this was going to be their loan amount, which, by the way, was on a 15-year fixed, I believe at 2.5% interest rate. So this was going to be their monthly payment. I just mentioned that in case anybody's got a mortgage calculator and they're wondering how could the payment be $2,506 for principal and interest, tax, and then insurance on a $300,000 home. It's because it was on a 15-year mortgage. There was a $99 HOA. So this was going to be their total monthly housing cost. Had the appraisal come in at value, but it didn't. The appraisal came in at $359,400. So the difference between the purchase price and the appraised value is $15,600. So in the world of lending, when you're dealing with government agencies like Fannie Mae, Freddie Mac, Ginnie Mae, Federal Housing Finance Authority, the Department of Housing and Urban Development, they have rules, and we as lenders have to follow those rules. It's not about what our opinion is, like, oh, well, these people have great jobs, great employment, great credit, so they're paying a little more for the house. We'll still do the loan as originally structured. It unfortunately doesn't work that way. So what would have to happen is the clients would have to come in this example, with an extra $15,600. That's on top of the $75,000 they were going to put down. And in my consult with Kelly's clients, that wasn't going to be an option. The capital wasn't there. So that was, okay, Keith, like, what can we do? And that's where the creative part came in. So here's what I did. I restructured the loan. Instead of putting down 20%, I restructured it so they would have 15% as their down payment. And problem or challenge or mental hurdle with that was the client said, well, we're doing 20% down because we don't want to pay PMI. So if we're doing 15%, that's going to mean we're going to have to pay PMI. And I said, absolutely. But we don't have to pay PMI on a monthly basis. We could do what's called single coverage, which means they pay the fee one time at closing, which they could also roll into their loan amount. That's another, I guess, meeting. But in this case, they just wanted to pay the fee outright. So here's how the financing was structured. We did a 15% down of the appraised value. That was this number. So that's $53,910 down. Plus we had to add to it the price difference between the appraised value and contract price. That's $15,600. And the cost, the one-time fee to buy out the PMI, so there was no PMI with 15% down, was this number, $1,527. So their total down is $71,037. Just going to stop there for a second and look back up here. That is less than they were originally looking to put down, even though we had these hurdles to get over. So initially they were like, wow, that's fantastic. But wait a minute, we're now borrowing more money. So that means our monthly payment's higher. Yes, it's math. You're borrowing more, your payment's going to be more. But let's look at how the numbers broke down here. So their payment was going to be $2,605 with their HOA. Now it went up to $2,642. That's a difference between original plan and new plan of $36.60 a month. So I multiplied that out and showed them $36.60 times 180 months for 15 years means they're paying in payment $65.88 more than they originally intended. But they're going to get a rebate against that cost outlay of the money that they didn't have to put down. This lesser down compared to original down was $39.62. So you really have to back that out of this cost, meaning their additional cost over 15 years to get the home they wanted was $26.25. So bottom line is, when you take a look at the $36.60 times 180 payments, that is the capital outlay extra on a monthly basis over 15 years. But if you back out the down payment savings, the actual net cost to the client over 15 years was $26.25. That number divided by 180 payments means they're really only paying $14.59 more per month, or $26.25 more over 15 years for the same property that they fell in love with before the appraisal came in. A winning strategy. And They signed off on it, and we closed escrow.
Exactly. And they can bank that $4,000. They could use it toward the any improvements they wanted to do in the house. If they bank that $4,000 and put it into, some kind of an investment, they probably earn anywhere. They're paying 2.5% on the money that they're borrowing, and they'll probably earn far more than that on a decent investment. And the property itself is going to, over time, appreciate at a rate far higher than 2.5% per year. 7-10 years from now, however long. I think they were planning on holding on to the property about 10 years. So it was definitely a win-win strategy, and worked out really, really well for them.
I'm going to actually just quantify that for people. So if the clients, like you just said, put their $4,000 savings on their cash to close, a mutual fund, or maybe they like Apple stock or Home Depot or Coca-Cola or McDonald's, and they just bought some shares and said, you know what, we're going to let it sit there for the next 15 years. We're not going to look at the price of the stock. We know it's a good company. We know McDonald's is still going to sell hamburgers. Coca-Cola is still going to serve Coke. Mm-hmm. Let's just sit on it. On average, with dividend reinvestments, and I do have white papers from Warren Buffett showing these numbers, conservatively with dividends reinvested over a long period of time, and a long period is defined by at least 10 years, you're going to see realized gains of 12.5%, 13%. That's what the S&P market averages perform and do. So if we just did something more conservative and said they put their $4,000 into Home Depot, they didn't put one more dollar in, and they let it sit there for 15 years, and maybe it only grew at 9.5%. Very conservative when you're talking about good companies and dividend reinvestment. That $4,000 is now $15,000 in 15 years, ironically. Mm-hmm. And if they had got into a little disciplined savings plan and maybe bought $100 a month, $1,200, still at a very conservative rate of return over a long term of 15 years, that $4,000 saving could be worth $55,000. And they could use it even earlier to maybe pay off the mortgage early. There's a lot of different ways to structure mortgage financing. And these are the type of strategies, and let me stop that screen share. These are the type of strategies and advice and technical expertise and professional negotiations that you're just not going to get when you go to like an app that you download to get your mortgage financing secured. And I think this is hopefully what people are seeing, is that hiring professionals that are experienced, time and tenured, with boots on the ground, and definitely experienced to reconstruct any winnable situation is why you hire professionals when you're buying and selling real estate.
Yes, I couldn't agree more. And I'll be honest with you, Keith, your creativeness, your creativity is one of the reasons that time and time again, I feel so confident when I refer people to work with you, because it's not just this one little piece. We need to look at big picture and have a plan A and a plan B and potentially a plan C. So from the very beginning, like when I consult with a buyer, what's your plan A? What's your plan B? What if this doesn't appraise? What if you bid on that property and you lose out because you bid too low and there were multiple offers? Now, are you going to be willing to maybe bring a little cash to the table that you don't want to have to, but maybe you're going to have to in an increasing market? So that's definitely why we love working with you. We love it that you lay it all out and explain it in easy to understand terms. And I think in this particular instance, what I'm so excited for these buyers about is that they're borrowing the big chunk of the purchase of that property at such a low rate, 2.5%. And I tell them, basically, your house is going to pay you to live in it. You have to have a place to live. You have to have rent or mortgage. Why not have something that you own? And in 15 years, they're going to have that property paid off, and it's going to be worth far more than $375,000. And as a caveat to that, I just want to add that indeed, there were 2 closed sales that closed in between the date of that appraisal and the date that we closed escrow that were both model matches, closed at $374,900. So was the appraiser off? Yes, he was. We weren't able to get him to budge, but we found other creative financing. And in the long run, the buyer came away knowing, you know what, I got the house for really what it is worth.
Yeah, I agree. And take mortgage financing and working with your clients very seriously. I take it on as if it was my own debt. We're taking on a large piece of debt. We need to look at all the different options and best ways to structure this debt. And then after the debt is in place, meaning the loan is funded and they're making monthly mortgage payments, strategies to help them get out of debt as soon as possible and save money, which is why I showed that calculator, because sometimes people aren't aware of, hey, what if I put a little bit less down? And like you said, I'm borrowing it at 2.5%. That's less than the rate of inflation. So technically speaking, if you're running a pro forma, a profit and loss statement, you're getting the money for free, which means you're getting the house for free. Implement some strategies. Sometimes when rates are this low, putting down 20% or more does not make sense. You want to do what investors and banks do, which is arbitrage your money, keep your capital, finance the most you can at the lowest rate that's basically free money, and then reinvest the money elsewhere at a better rate of return, like in the example on the calculator, to the point where with some of these strategies, even on a 30-year loan or 20-year loan or 15-year loan, I've been able to help clients get their homes paid off in 6, 7, 8, 10 years if they implement the strategies that we educate them on. Not everybody does. Some people want to take that extra $100 a month and they want to go out for a nice dinner every Friday, which I guess would take probably closer to $400 a month, but you get the point. And so that's the type of service we want to deliver to your clients every time.
I agree. I know we got really deep into the weeds on this, but I appreciate anybody watching for your time, and that you can spend some time getting educated, whether it's for yourself or for your family member, because there are ways with the guidance of good, solid, professional loan officers like Keith that are going to help you save money and win at this game of real estate. So that's what we're here to do. And Keith, once again, I appreciate your time. I know that this is it's so inspirational for me, and I hope that buyers and sellers, everybody walks away with this information just feeling inspired to know that I have options. So thanks again for your time today.